Good afternoon, everyone. My name is Joe Brantuck. I'm a vice president here at Listings, based here in New York out of the NASDAQ market site. And we certainly want to welcome you all to the Canaan's first Fintech Central event of this year. We are thrilled to welcome Canaan partners back to the NASDAQ market site. We applaud Canaan for their great efforts in curating this wonderful quarterly series that brings together entrepreneurs and investors across the fintech space. Now today, you'll hear from some of the top fintech company builders and experienced regulators to discuss the current state of financial regulation, corporate governance, and compliance.
My name is Michael Gilroy, and I'm an investor with Canaan Partners here in New York City. For those of you who don't know us, we're an early-stage venture capital firm, and we invest across both technology and healthcare. We're big believers in the future of fintech and have invested in over 20 companies across the space, including Orchard, who's up here with us tonight. Tonight we're going to talk about regulation in fintech. It's a topic that many early stage companies really try to avoid, but at Canaan we feel like we should really approach head on. So up here tonight is a mix of both ex-regulators and startup CEOs. So let's go down the line and introduce everybody, and we'll jump right in. Lowell, kick us off.
Thanks, Michael. My name is Lowell Putnam. I'm the CEO of Quovo. We're a financial account aggregation analytics platform. You can think of us as the guts of Mint.com type experiences where people can aggregate all of their financial accounts in one place. We have a sort of double sales model where we sell into fintech startups and also into large enterprises. We've been around since we got our seed funding in 2013. We're located here in New York.
And I'm Troy Paredes. I'm a founder of Paredes Strategies, focused on compliance, fintech and otherwise, corporate governance, government investigations, and related topics. Before that, I've been a commissioner at the SEC from 2008 until 2013. Before that, I've been a professor of corporate and securities law. In addition to my work as a consultant through my firm, I also sit on the board of advisors of a fintech company, and until recently I've been on the board of another fintech company, so see fintech from that vantage point as well.
Hi, Ben Lawsky. I have my own consulting firm, but also from 2011 to 15, I was the regulator here in New York of insurance companies and banks. Before that, I worked at the New York Attorney General's office, and before that, I was a federal prosecutor for a bunch of years here in Manhattan. Yeah, that's basically it.
Matt Burton, CEO and co-founder of Orchard Platform. Orchard is focused on improving transparency and liquidity within the lending space. So most of you know us from our work that we've done with a lot of the marketplace lenders or peer-to-peer lenders. But similar on the dual sales strategy, we're seeing now more traditional financial services companies move into the space as well, and working with them on a variety of services.
Awesome. So as we look at businesses and industries that have begun over the last couple of years, generally it's catalyzed by changes in technology or regulation. And a lot of people say, marketplace lending was catalyzed by changes in regulation, and you have folks like Betterment that benefited by ubiquitous smartphones. And today we're hearing a lot about regulation changes with the new administration in addition to artificial intelligence. So I was just wondering what each of you felt were some of the most important or biggest opportunities in fintech today, and if they are being catalyzed by either of those variables. And Lowell, I'd love to start with you.
Sure. So similar to what you already said, I think that in the B2C fintech space, we're seeing a big drive towards personalization. And I think enterprises are also picking up on this. That when I had to start a checking account to pay my baby nurse about 8 months ago, I realized I went to the two biggest banks here in the city, and between both banks, I had 4 different checking account options. And I think that really says there needs to be a lot more personalization for financial services products, especially direct to consumers. Betterment, Wealthfront, the wealth management space, SoFi in the lending space, a bunch of new insurance companies are giving personalized products out to the end consumer. And I think from a regulatory standpoint, there's something really exciting happening at the small financial brands, the community banks and the credit unions out there that are being heavily supported through regulatory efforts. That's a huge opportunity for these smaller brands to build personalized products. So I think a boutique, curated, personalized financial services experience is going to be one of the biggest trends that we see coming out of these traditionally small and sleepy brands over the next couple of years.
Troy?
One of the areas that I think is going to increasingly be hot is RegTech. And maybe that's partly a reflection of the fact that a lot of my background is from the compliance side of things and the governance side of things. When you think about the demands that are placed on financial services firms, and quite frankly, firms outside of financial services, there's going to be a limit to how much human beings can do with eyes and ears. And what I've long thought is you think about the power of data, you think about the power of technology, and you apply that to compliance solutions. You can think about it more broadly than compliance in terms of governance as well. The opportunity there, and it could be everything from AML, it could be suitability, it could be things outside of financial services, it could be insider trading. We can go on and on and on in terms of what the issues are. But one thing we know, and I think quite frankly, whatever the political winds may be now or 4 years from now or 8 years from now, the fact of the matter is there's a whole heck of a lot of regulation on the books. And it may ebb and flow, and the contours may change, but there's going to continue to be a whole lot of regulation on the books. And that is to say a whole lot of need to comply and a whole lot of focus on enforcement, again, without regard to who happens to be in power at any particular moment in time. So the demands on those who have to comply are going to continue to build and mount. You flip that around, I think therein lies the opportunity. And to kind of put a punctuation mark on it, one of the things you've seen over the last 4, 5, 6 years, and it's at an increasingly rapid pace, is regulators using technology and data and artificial intelligence and machine learning. And so one of the things I like to tell folks is look, if your regulator's using all of those capabilities to think about whether or not you're complying, the expectation is you're going to be doing some of that same stuff. And if nothing else, do you want the regulator to know more about you than you know about you? Probably not. So I think there is a huge opportunity there for folks to come up with solutions that are technology-based, again, whether it's for financial services or what have you, that have an eye on compliance and governance more broadly.
Yeah, Ben, you and I have talked about this a lot, but curious where you see the opportunities today.
Yeah, well, I'm never one to not take the opportunity to challenge the premise of a question. So, I think that you started by saying that change is often driven either by regulation or new technologies. I tend to think that change is often driven a lot more by the tech. I think it's a very dangerous game as a company to get into building business models around a change in regulation. Because, of course, change in regulation or change in law can always change again. And what I tend to look at is new technologies that are driving real improvements and efficiencies, and then figuring out how we deal with the existing body of regulations that are out there for these new technologies, which are often a really tough fit. So, the Bitcoin and BitLicense stuff we did back when I was at the Department of Financial Services here in New York, I think is a decent example of all that happening. Certainly the regulation didn't drive anything. The technology, the new technology, blockchain, Bitcoin, et cetera, drove it, and then we had to figure out as regulators what to do about that, and I think companies had to figure out sort of how do we fit this new technology into a world of regulation. The things I get most excited about, to really answer your actual question, tend to be in two main places. One is either where markets are broken and new technologies can help fix those broken markets, or where you just look in areas, and Troy raised one of them, where the technology is, in the financial services industry just stinks. And we have a lot of that. You can look at various aspects of the insurance industry. You can look at the anti-money laundering technologies that most of the banks around the world use. The technologies are actually quite poor. And new developments through machine learning, AI, et cetera, are causing some really interesting companies to start to pop up. And I think you're going to see, not driven by regulation, but driven by maybe regulatory desire for improvements amongst the entire community of financial services providers to get better about scary things like money laundering, I think are going to drive some real improvements, I hope.
I think one other point that hasn't been raised is just a shift in consumer behavior and the adoption on that side. So a lot of the B2C companies that have done really well, specifically in fintech, tend to have products that are really good fits for millennials. So if you look at SoFi, they're targeting that student loan, which is one of the first decisions that students need to make after graduating. If you look at Lemonade, if you look at Betterment, they're really kind of those first-tier products. And as this generation ages and moves into buying homes and doing other pieces, then you'll start to see that technology shift move through the rest of the ecosystem. But I think a large part of it is driven by the technology enabling a new consumer behavior expectation.
Just to build on that, I mean, so interesting, the headline today that SoFi wants to be a bank.
Correct.
By the way, they're not going to get an OCC fintech license. They want to be an actual bank, an FDIC insured bank. So, that's again, technology drives a great solution, and then, well, okay, how do you deal with regulation? It's really interesting to see some of these players now saying, we're going to take it on full scale. We're not scared of regulation. We're going to try and be an actual bank. And if SoFi does that, I think that's a watershed moment for the fintech industry.
I think to pick up on Ben's point, I think one of the things that technology allows for is just the kind of innovation that expands choice. And then folks, like yourselves and others, will figure out, all right, how do we want to situate ourselves? And we may want to situate ourselves here day one, but year 1 or year 5, as we grow, as we see other opportunities, as the landscape, the competitive landscape, and the technology continue to evolve, we may want to go back to what was old school and actually make old school new school again, depending upon what the business judgment is. But technology gives more choices for folks in terms of the business models and how to execute on those models, and it accordingly gives more choice to consumers, whether those consumers are people buying widgets or whether those consumers are investors. And I think overall, not that everything is perfect, in fact, nothing is perfect, but the fact of the matter is, I think when you have technology driving that sort of choice, I think overall, the benefit too inures to just the public as a whole, and just economic growth and job creation, and just keeps us on our toes. And I think it's a big picture, a 30 or 50,000 foot level benefit that flows from all the stuff we're talking about.
So pushing on that, right, as we all think back to our economics 101 classes and economic growth, and what you need for that is justified and consistent legal structure, right? And a lot of people are saying today, regulation is changing so much that companies are constantly trying to look around the corner from a regulatory perspective. Does anybody feel like we're at a point where, laws are changing too frequently and it's hurting innovation? I'm sure the ex-regulators have a point of view here.
Well, it's undeniable that, especially if you'd asked me this 6 months ago, that we're in a world of hyper-regulation. I mean, you couldn't have much more. You really couldn't. And, that said, we're starting to move somewhere different now with the new administration. Who knows what that means, and it's going to take a long time. You see the Treasury report yesterday, starting to talk about rolling some things back. But, around the margins too, right? They want to help community banks, smaller banks, which actually probably does make some sense that you don't have one size fits all regulation. So, I've always thought, wouldn't it be nice that if we didn't have to live in a world where we swing like a pendulum from hyper-regulation to complete deregulation, and couldn't we find sort of a Goldilocks happy middle where we had smart regulation that allowed for innovation and allowed for the things we want, but, set bright lines. Since the NBA is on my mind today, I always thought of a regulator as a good NBA ref. The best NBA refs are refs that kind of, when the game's going on, for the most part, you don't notice. Except there are rules that everyone's playing by, and when someone violates the rules in an egregious way, the whistle blows, and for a moment you notice the ref, and then the game resumes again. You don't notice the ref anymore, and the players are left to innovate and play to their heart's content and really push the boundaries of what they're allowed to do. I would like to see us move towards a world, you didn't really ask this question, but I'm answering it, where we're sort of in the middle. We're not hyper, we're not deregulatory.
And calibrating it the right way is hard to do, but I think that's what we're all striving for. To pick up on an aspect of this, the value of certainty, or the chilling effect of uncertainty. Mm-hmm. When you have folks, stipulate everybody in this room, who's trying to get it right, and you're not sure where the line is. Not that you want to get close, or not that you want to, try your luck, but when you sit back and you honestly say, I'm not sure where the do's and don'ts are. And I think from a policy perspective, if folks are unduly conservative, then you can have a lot of innovation which is left on the cutting room floor. At the same time, if folks are overly aggressive, then you have violations, and that's a problem without question. So I always think about it and thought about it, and you have these kind of two different dimensions. One is just the substance of the rules of the road, and everybody up here and everybody there would have their view as to what the substance of the rules of the road ought to be. What should we prohibit? What should we mandate, et cetera? There's another dimension to this, which is, I hear this all the time, whatever the rules are, I just want to know so I can figure out. And these are folks who are trying to get it right. I just want to know so I don't go too far, but I also don't, again, leave a business opportunity on the cutting room floor because I'm not sure. I think regulators there can kind of internalize that point and say, all right, how do we provide certainty in a way which is sensible, because overall that's going to be good for the folks who are regulated, but it's going to be good for all the folks who are going to benefit from those new innovations that otherwise may not get taken advantage of.
I guess the one issue I take with that concept is that we can all agree on the rules of the road. I think that with technology in particular, the rules are changing very, very quickly, and I think that the current regulatory framework or the way that a lot of regulation works today is it's a reaction to problems that happen, or it's a reaction to things people are afraid of. And without being prescriptive or too predictive with it, in 5 years, and obviously I'll take an issue close to Quovo's heart, which is the ability for customers to get their own data from banks. I think that 5% of people actually care about that today, because 6% of people actually try and do it. And so in 5 years, though, it's not going to be 5%. It's going to be 30 or 40 or 50%. And so if there's not a regulatory environment that's put in place today to predict that when 50% of the people actually want to access that kind of product, there's going to be a problem. And maybe that's just a boogeyman, because I think here in the US, the data sharing ecosystem is actually working pretty darn well, and it's being set by the banks, as opposed to Europe, where it's being mandated through regulation and doesn't seem like it's really going much of anywhere. So maybe it's not a great example, but I do think trying to create a regulatory environment that predicts customer choice in the future because of access to new technology that people don't even think about today is a real challenge.
It's definitely, though, a large challenge for like a lot of the fintech companies that I see that are starting up. This issue right here, what we're talking about, is so core and so difficult if you're actually trying to do something that's never been done before. If you're going to go down a path and make, consumer unsecured loans, there's a fairly well defined. You can go the state route, or you can go through an originating bank. But for a lot of the fintech startups who are taking brand new paths that have never been done before, it's very difficult. And one of the challenges I've seen is just when you talk to the regulators, different groups within the regulators don't necessarily agree. So would love to hear your thought on how to deal when you are bringing kind of new problems to them and there's dissension. How do you guys think about that?
Well, it's a great question. I think the regulators are supposed to have a chain of command that they're, at the agency, and for important questions, they're supposed to kind of go up the chain. And hopefully, if you go in and see one person and they give you one answer, and then they come back to you and say, no, my boss says it's a different answer. Sorry, we don't know the answer. Hopefully that can sort of, in theory, you should be able to appeal it up and get a final answer. I always felt like my job at DFS, as at the top of that pyramid, was not to have all the answers, but was to resolve the really tough questions that people couldn't agree on at the very end of the day. And other than that, let everyone else do what they're supposed to do. If that's not happening, that's a failure at the agency. And I think that's a problem. I think the bigger problem may be what Troy mentioned, which is this just limbo. I see it now on the private side. You need an answer. Often you talk to the lawyers who will say, that's a really good question. We've never faced that before. And the best lawyers will say, you have a little bit of risk if you do that versus a moderate risk or high risk. So then you can make a decision. But then when you go to the regulator and say, could we find out whether we can do this or not, often the answer is, we'll get back to you. We had a saying around the office. I used to pound it into my team, no is the second best answer. Yes is the best answer. No is the second best answer. I'll get back to you, or maybe, or limbo, or no answer, or no response is a terribly debilitating answer for businesses. And that, I think, a lot of regulators don't get. And look, regulators are very busy. They have lots of things going on. They're not only worried about fintech, they're worried about a bank blowing up or an insurance company going under or who knows what crisis of the day every day. But you have to be able to get answers in some kind of reasonable time frame or you just squelch business. And I just say, you don't even mind getting a no as a business. So give me a no, I'll design around it. I'll figure it out. Tell me what I can do and what I can't do, and my business will figure it out. It's the we'll get back to you that just puts you into complete world of hurt.
So to push on that a little bit more, so Lowell and Matt, you're both CEOs of businesses, and Matt, I guess one thing that you just said you did is go and physically talk to the regulators. What else do you guys do inside of your businesses to navigate the kind of regulatory landscape today?
Yeah, I think one thing that I wish I had been told a couple years ago was to, and Troy, you brought this up a little bit, is think of the regulators as clients as well. And so, I think we've had better conversations when we've kind of talked to them saying kind of, what are your problems? What are your blind spots? What are you not seeing in this space? How can I help you? And then that leads to much more productive conversations than just walking in and saying, I have this problem. But I think that if you're going to build a lasting business and you're going to really have it scale, and there is some regulatory uncertainty, you have to go talk to the regulator. You can't just kind of sweep it under the rug because eventually it's going to come up. And I think that that's it's been an interesting past couple years because I think that the regulators are now dealing with the fact that there's, you can follow this space 24/7 and not keep up. And that's a scary thing for them. But at least I think that they're leaning in a little bit more now.
I think we've seen some success in abstracting these issues up to a level where hopefully human beings can agree on them. And so for us, even though we're not very highly regulated, neither most of our customers, we think about, with consumer data, if we all agree that we're taking the consumer's viewpoint, or we're all consumer advocates, it actually aligns Quovo, the regulators, and the banks, and Betterment, and everyone actually gets on the same page really, really quickly. It's the one thing that everyone can actually agree on. So instead of dealing with data sharing principles about what's an information security concern, what's a data privacy concern, what's a whatever concern, we say, okay, let's table that and actually agree customers own their own data. Not everyone agrees with that, but that's a great thing to actually get alignment on. Regulators tend to agree with that. Customers should then control what happens to their own data if it's their property. That's a really nice thing to anchor on too. And so really it's taking some core customer or consumer focused principles that make the issues, I think human issues, that make it much easier for us to find alignment between the different constituents.
And that's a really important point, and it really is the undercurrent among what the others have said, which is, I think oftentimes there's the way things are phrased or framed, out of the box it appears as though there's disagreement. And yet the fact of the matter is there's often a lot of agreement in terms of objective. There just may be different views as to how you're going to advance that objective. In the lens of, or through the lens of the SEC, where I was, there's often this kind of pitting of, are you going to facilitate capital formation or are you going to protect investors? As if you have a choice. And a point that I used to stress, and I continue to stress, is I don't think we have to make a choice. That if you're thinking about making it easier for companies to raise capital, whether that's public markets or private markets, the fact of the matter is it's good for companies, but it's also good for investors because investors now have more things to invest in. Again, not to say every investment's going to pay off, but it is to say expanding investment opportunities is a pro-investor thing, not just a pro-capital formation or pro-issuer thing. That itself, I think exactly what that itself is to say, all right, we're not talking at odds. We're actually on the same page trying to advance the same goal. Now let's talk about how we're going to do it. That can actually go a long way to making conversations much more productive.
So you started to touch on it there, and Troy and Ben, I'm curious to get your point of view. I guess what we're hearing from the entrepreneurs is engage in a conversation, but you guys are sitting at a point where there's hundreds of businesses with competing interests coming at you with different information. What is the best way to engage in that conversation, and how, what's the style that's been most successful in your experience?
So for me, what I always like to see is a lot of rigor to the analysis. Yeah. Which is not just, I want X, therefore do Y, or I want X, therefore don't do Z. But walk me through the steps. I'll make my own judgment as to whether or not I think those steps will actually follow one from the next. But it's one, what everybody I think was saying before, which is what are we trying to achieve, and thinking about it through the eyes of the regulator. thinking about it through the eyes of the SEC's mission, for example, or the OCC's mission, or the DFS's commission or mission, or whatever it happens to be, but then walk through, look, we need to be able to do X, and here's the way it's going to play itself out, and that's going to be good for the mission of the regulator. I think that's really powerful, and I always found that to be quite helpful. I didn't mean I always agreed with what somebody was saying to me, but at least then I could see what was the rigor or not of the analysis, and if it resonated, if it made sense, it certainly gave me that much more to think about. And again, if it was thinking about it from the perspective of how is this going to actually advance the regulator's mission as compared to what's in it for the person coming to visit, that's an important starting point as well.
I think it's also got to be multidimensional. In other words, if you're a fintech company, insurtech company, RegTech, GovTech, whatever tech you want, if you're going in to see a regulator, you shouldn't be thinking just about that one meeting. It's got to be, is there a trade group you're a part of? Could they weigh in with the regulator? Is there a political group you're somehow a part of that may be talking to the governor's office? I'm using DFS in my mind. Are there other people in your industry who have similarly aligned interests, be they incumbents or be they startups? Because I used to tell people, you forget, especially if you're a startup, the regulator and the people that work at the regulator are sitting down with banks and insurance companies, at least in DFS's case, all day long. So there is an ongoing dialogue, day in and day out, between the regulator and, in many ways, who they view as their clients, the industry. And that dialogue, just on every little thing, whether it's a new product, whether it's a problem, whether it's an exam, enhances the relationship between the regulated party and the regulator in a way that there's almost some trust there, often. And when something comes up for a big bank or a big regulator, they all know who to call. They've got relationships 5 deep in the agency. The CEO can call the superintendent if they need to. And there's this sort of deep, developed relationship that's been there for years. And I was shocked when I first got to DFS in 2011, with just the number of meetings I had right out the get-go. Every bank, every insurance company, every CEO just wanted a coffee to have the sit down to introduce themselves. And then I could see there was a whole process going on where then, as I hired my senior staff, people were coming to see them. And it was this whole relationship that developed. So I think you have to get beyond just we need X, which is what Troy's saying, but you also have to get beyond we need to go in for one meeting and make our case, and that'll resolve the thing one way or another. It's not about that. It's about a much more systemic relationship with the various regulators you face. It's a ton of work. But if you're in a position where you're going to be going back periodically to say, we're doing something new, we want to tell you about it, you want that relationship of trust, and it's just like any other relationship in your life, you have to build it.
Yeah. So one question that we always get is, what is the actual process when we approach the regulator, right? And so I'm curious if we can get a little bit of insight, a look behind the curtain for both the SEC and the DFS respectively. Is there anything that you can share that may be kind of surprising to the audience?
So for me, when I was a commissioner, when I tell people this, they usually are pretty surprised. It was actually pretty easy to get a meeting with me. You had to ask, basically it. Mm-hmm. Right. Now, simplifying it a little bit, right? There are certain instances where I couldn't meet with somebody for one reason or another. But overwhelmingly, and I don't think this is unique to me, my view was, look, if somebody wanted to come in and meet with me, I wanted to get the benefit of whatever they had to share. And that wasn't just if people were going to come in and agree with me. That's if people were to come in and disagree. That's if people were going to come in with an ask. That's if people were to come in, as Ben said, and I think Ben's exactly right, where they come in and say, hey, look, we just want to share perspectives and offer you our insights, such as they may be worth. My default was, if you called for a meeting, I'd give you an hour. Sometimes people wanted 30 minutes. Sometimes they wanted less. I didn't force them to spend more time with me than they wanted to spend with me. But my view was, I wanted there to be enough opportunity to kind of have the discussion where it wasn't just somebody coming in with their 5 talking points, ramming through those, and then walking out. I wanted to have the opportunity to ask questions and to press and to probe. And sometimes I'd ask questions and people may walk away saying, wow, you really didn't like what we said. The answer may be, I totally agree, but I wanted to see what you were going to say in response to my questions. So it was very easy to get those meetings on the whole. That's if you're trying to meet with the commissioner. With the staff, I think, again, picking up on Ben's point, there are all kinds of different ways. I mean, there's the ability to call and have a more informal discussion, right? There's the ability to, come in and have what is a more formal discussion. But at the SEC, and I'm sure DFS is probably their analogs, there's all kinds of formal action you can ask from the staff, whether it's no action relief or exemption, what have you. So there's all of those sorts of levers. Each one of those has its own mechanics. But for the most part, I think it's a lot easier to get into the SEC, at least, than what a lot of people would think. And again, as I said, if folks would have called my office that would like to come in and meet with the commissioner, the answer, unless there was some reason I couldn't meet with them, would be yes, then it was just a matter of scheduling.
I guess I would take this question just a slightly different direction, so I don't have to repeat everything Troy said and bore all of you. Don't underestimate the challenges that the regulator faces in both keeping up with their day-to-day work and keeping track of all the new technological developments. And also don't underestimate how tricky new technology is when you start to dig down deep into the agency. So when you might have a superintendent or a commissioner who's really interested in new tech, but at DFS, for example, there were 1,400 people who worked in the agency. Probably 1,000 of them had been there 25 years, and they've been doing their jobs the exact same way, day in and day out, for 25 years. So maybe before there was an internet even, or certainly before there was email. And that is a big challenge you face. And some of you have heard me tell this story before, but I'll tell it again. I'll never forget getting a call one day from someone in the governor's office who had heard from someone else who was calling on behalf of a guy named Jack Dorsey, who was just asking very politely, I have a license application pending for this company, which at that time we hadn't heard much about, called Square. And it's been pending for a year. I don't want any special treatment, but just been pending for a year. Could you check on that? And I had a whole rule that I didn't want anything pending for more than 40 days, so I was upset and grabbed my team, and I hadn't heard about it. I went down to the licensing division in our 3 floors down in the building, and sat down with a bunch of people I'd never seen before in my life, frankly, and said to them, do you have an application pending from this company, Square? He said, oh, yeah, sure, we can have it, it's pending, it's all good. And I said, well, it's been pending a year. I have my 45-day rule. What's the story? And they said, well, there's an exception to the rule. If they change their application, if they update the application while the license application is pending, we restart the process. And that's what they do for everyone. I said, okay, that makes sense. If they're changing the application midstream. I said, how long does the application process usually take? 4 to 6 months, fine. And why are they updating their application? Well, they're updating it all the time, and they're updating it, sir, because of software updates. So I look at them, I said, that's what tech companies do. In a 4 to 6 month period, they're going to be updating their software periodically. And I said, so how often are they updating the software so that you're putting them back at the beginning of the 4 to 6 month line? And they said, I think every 3 or 4 months. And so I looked at them, and they're looking at me, and there's no ill will. They're staring right at me, and I'm smiling at them at this point, saying, you understand this is a Kafkaesque situation where they will never get out of this application process because you keep putting them at the back of the line. And these are not bad people, but they're just looking at me, no change in their expression. And so I said, do you have any other applications like this pending? Oh, yeah, Facebook Payments Company, Google Payments, a couple others. And, my jaw dropped to the table, and we took all those applications. We gave them to a new group of people who had sort of a different attitude towards new technologies, and I gave them a month to get them all done. Again, saying you can say yes or you can say no, but give everyone an answer, and we got them all done. But if I hadn't gotten that call, those applications probably would have sat there a while longer just because it was a big agency with lots going on, and new technologies just provide some awesome challenges for people have been doing things a certain way for a long time. So I guess the moral of the story is regulators need to improve too.
Awesome. So I have one more question, and then we'll open it up to the audience. But I always like to end with this one, and we'll go down the line here. And for the entrepreneurs, the answer cannot be your current business. But the question is, if you had to start a fintech company today, what vertical would it be in? I know I didn't prep you for this, so go for it.
You didn't prep me at all. I would say a credit card business. Maybe that's because I worked in the credit card space before working in fintech, and I am shocked that there are not better options for people to have a credit card that actually meets their needs, that doesn't come from the same company that your parents got you a card from. The best way to get a credit card today is to have your dad get you a credit card, and that's why I still have an Amex, and that's ridiculous. I think that there should be a credit card that actually fits my needs as a 35-year-old with a child and with a fintech company, and I'm just using the same card I had since I was 16.
Troy?
I do something in the RegTech space.
Okay.
You know, I think I would build some kind of annuity company. I think there's not enough focus on, there's a lot of focus on managing the wealth of young people, but you have this enormous group of people now retiring with a lot of wealth. And there are a lot of interesting new products that could be developed and pushed out to them in really responsible, smart ways that would really help them with their retirement and the rest of their lives. And that would be fascinating to build a company like that.
I think one space it's getting more interesting is, and it's a pretty crowded space today, but the personal financial management space. So I think that as you look through and the data becomes more accessible and you actually get itemized receipts, so it's not that I went to a grocery store and spent $200, but I actually get a breakdown of exactly what I spent the money on. I think we're going to see an explosion of useful personal financial apps on that side, and that is now starting to also drive a lot of the adoption of other products within the fintech space. So whether you're selling renter's insurance or loans or other places, I still think that that's an interesting piece in the value chain.
Is it on the roadmap?
Let's do it, yeah. let's do it.
All right. Awesome. Any questions from the audience? The question is just reaction to the fiduciary responsibility.
Very quickly, we work with a lot of companies in the wealth management space where the fiduciary rule from the DOL has been on everyone's mind. I think the market is pushing that direction for wealth managers and investment advisors to provide a fiduciary level of care. I don't know if it has to be a regulatory issue. I think the market's going to push that direction anyway, but that's just one vertical.
Yeah, it looks like the rule's going to get somehow amended or undone, but we'll see. That's sort of what's coming out of Washington. That's what it sort of looks like from the recent comments, but I'm not an expert in that rule. The notion that someone who's managing money for someone should have a responsibility to do that wisely and fairly seems non-controversial to me. So I'm generally for that rule, and I'm not sure what the objection to it is, but apparently I don't know all the details well enough to understand all those objections.
Other questions?
If you could talk in that context a little bit about how you think about the OCC FinTech charter versus what I presume SoFi is doing, which is trying to apply for a de novo ILC of some sort where they're not subject to bank holding rules. And as you know, those have not really been, those are not something that the government has, or the FDIC certainly has approved in the past few years. And I'm curious as to how you see things evolving in that way. Do you see bank licenses being given that are not subject to full bank holding rules?
It's a fascinating question, and I don't know what happens. I mean, it's clearly the alt lending market is maturing to a point where you may see multiple companies applying either for the FinTech charter or for an industrial bank license or some other trust license. Generally, my reaction is that's a positive development. It's companies who are using new data sets, new technologies to make lending more efficient, and at the same time, they've got the capability to get a license and comply with all the things one would want them to comply with. I think from the regulatory side, to see the OCC developing the FinTech charter, whether it's perfect or not, I think that's got to be just a generally positive sign that the largest, most important bank regulator federally in the country spent the time to come up with a path for FinTech companies to get a license. That path may be very onerous, but at least just the fact that they got their heads around it, and Amy Friend, God bless her, spent a couple years of her life putting that thing together, and I just generally think that's all the devil's in the details, and this is all going to remain to get worked out. But between the OCC's focus and how that's driving even states to now get focused on this, even though they're not happy about it, at least now they've got to get their arms around it as state regulators. When you combine that with companies like SoFi seeking a license, I think it's all kind of positive movement in the direction of better, safer, smarter, more efficient lending activity, which I think benefits small businesses, it benefits consumers, it benefits students, et cetera.
Well, and you have the SEC focused on FinTech, you got the CFTC focused on FinTech, you got FINRA focused on FinTech. They're all trying to figure out how the technological change, right, impacts the regulatory thinking, right? Set aside the particular rules on the books, right? How does it challenge the way we think about the whole regulatory approach, particularly where the whole essence of it is can we scale back in sensible ways regulatory requirements to try to spur the innovation, right? So there are some big picture ideas that the regulators across the board are thinking about, and it's going to take some time to figure out how that actually translates. It comes back to the certainty point. The other thing too, I would just note that always makes me a little antsy on all of it. While I think it's on the whole good that the regulators are trying to rethink the regulatory environments, when you start coming up with regulatory requirements that are tailored to this industry or to that industry, one does start to wonder about how all those rules are going to be crafted and the extent to which regulators will say, well, I like what you're doing over here, so we'll give you a special set of rules, and well, we don't really like what you're doing over here, and so we're not going to give you a special set of rules. So I think there's a lot to keep one's eye on in terms of how it plays itself out, but I would applaud the regulators for saying, look, we need to take a step back, we need to think some serious, deep thoughts on this, and see how we can go about adapting the regime to make sure that we don't stifle regulation, stifle innovation, and rather can find ways to promote it.
A couple more here. Yeah, here.
Thanks, guys. So I think what would make an effective regulatory sandbox? Are there any good case studies of companies that have worked with regulators before?
So I'll answer it. There's been a lot of press releases on Sandbox, especially as you go out internationally. So Singapore is the one probably being the loudest in the fact that they have this sandbox. The more that I've dug into these from an operational standpoint, it's normally not the regulators who are doing the day-to-day who are pushing for these sandboxes, but more for the country development offices. And so I think it's slightly misleading if you just read the press right now on what is available within sandboxes today. Because I think that in all the examples I've seen, it's like they'll allow you to maybe do a little bit, but then if you scale up at all, it's, you're gonna have to start the conversations over from scratch again with the real regulators.
I think I've worked with a couple companies that have engaged the CFPB in their Project Catalyst. I don't have a case study for you because I can't talk about it publicly, but I was impressed with the engagement from the CFPB. A guy named Dan Kwan, who works for Richard Cordray, is flying all over the country all the time, talking to startups, and I think has done the best he can. And again, they're trying. It's far from perfect, and I think there is a danger that everyone just wants to say they have a sandbox because you don't want to be criticized for not having a sandbox. You risk just saying I have a sandbox and not making sure it's actually decent. And at least with Catalyst, I've seen some companies get a lot of benefit, especially because it starts a real engagement between an early stage company and the regulator. And if you're a fintech company that is primarily regulated or significantly regulated by the CFPB, that's a really good set of relationships to start developing early in your company's growth.
Awesome. Well, thank you everybody for joining us tonight. Please join us for food and drinks out in the lobby, and please give a round of applause to the panel. Thank you guys for your time.